Good afternoon, friends. Great to have everyone join us. Thank you for joining for this very, very important topic where if you guys are like me, we're right in the middle of tax season. So we're all thinking about this. I'm gathering information, sending it off to other people, which is great. For me, not so great for my friend and special guest, Laura Johns, who is on the receiving end of that. But we're super excited for this content today. We love to have Laura join us. She has been a frequent speaker for us and is always a guest fave. She's always got great information to share and really helpful content. So we really appreciate that. A couple of logistics and then a few Hinge announcements before I turn it over to Laura. First of all, we would love your questions. So if you're joining us for the first time this year, this is a new platform. We love, love, love it. It's so simple and interactive, and we love our engagement with you guys. So over to the right of your panel is a Q&A box. Please add your Q&A, add your chat if you would like to say hello. I will monitor that during Laura's content, and we'll come back on and save some time at the end for your questions. And also we have a poll embedded in the content. So you will also see the poll icon over to your right, but when it's time for the poll, it should pop up on your screen. Give us your best guess, nothing's wrong. We'll kind of gather some opinions on where you are in your tax preparation and how you feel about it this year. So thanks again for joining. Hinge is happy to be here to support you guys with thinking about the future of your business. We have developed resources to help people understand what their business is worth and what strategies they can put in place to make that more valuable, not just for the future exit, but for the operation of the company today. So tap into our resources. We would love to have you guys join us for anything meaningful for you. We do have our annual Thrive event coming up the 1st of May at the Rittenhouse Hotel in Philadelphia. We're really excited. We love this event. It's ability to send us your financial data in advance. Our 3-person analyst team will analyze that for our guests. We'll give you some information when we meet with you the afternoon before our day-long event about where your best opportunities are in our financial content and in creating a company that's extremely financially healthy so that you can better serve yourself and your families and your teachers. So this is a very fun event. We have a few seats left. I hope that I'm correct about that as I'm saying it, but I know people. So if you guys try to get in and have any trouble, certainly reach out and I'll do what I can to help you. But consider joining us there if you would like to better streamline your financial practices and better strategize how you can be more financially healthy. Save the date now for our annual Shift Conference, which is November 4th through the 7th in Santa Barbara. We'll open registration then for that event, August the 1st. I'm putting together some really cool content, so I'm excited. As I go throughout the year, I'm listening to everyone and their challenges, and I'm listening to people say, hey, there's a really interesting thing going on over here. And then, of course, I immediately try to get that person to come in and share content. So in addition to very meaningful content, it's a cool place. It's a great time to relax, meet some new people. The contacts there are amazing. And one thing that we really love to do is to honor you guys as business owners and business leaders in treating you really well for a couple of days. So we'd love for you to join us for that event. We do have a QuickBooks training class coming up. Our financial team has worked really hard to develop a protocol for QuickBooks that's industry specific. We love QuickBooks. I use it for my company. Many of you do as well. But we have developed a training program and a business management system for QuickBooks that's specific to childcare. So register for that. You see the URL there. Well, that's coming up on March the 19th. Here is our amazing financial coaching team doing great work with clients, Christine, Stephanie, and Zach. And if you have the need for financial coaching, these guys are doing a fantastic job with business owners. Tom Wood presents our leadership sprints for companies and for teams, and he stays super busy. We've gotten great feedback from what he's accomplished in helping people bring their team together for 30 minutes a week to think about different topics and to think about themselves individually and their work, because we don't think you can separate the two. I think he has a few spots open for the spring, so certainly we reach out if you have an interest in that. And then lastly, join us on social media if you're not already. That's where we announce opportunities that are coming up and where we might be in your area. If we're speaking in your state, we'd also like to see you. So scan away or reach out or go to hingeadvisors.com and get signed up for that. So thank you so much for joining us, Laura. I'm so happy to see you. It's great to have you, and thank you for the time in this very, very busy time in your life. So welcome. And
thank you.
I will turn it over to you and see you in a bit for some Q&A.
That sounds great. Thank you, Kathy. I am thrilled to be here. It's a nice break from what I tend to be doing on a daily basis at this time of year. And I was just commenting that this is the best and the worst time for a presentation like this. It's the worst time for a person like me, but it's the best time for the audience because I have some really practical things that you can look for when you're presented with a draft of your tax return. And I'm just excited to share those with you so you're as in tune as some of us insiders are in terms of what the current landscape is. So the first thing I want to talk about is that we have some almost breaking news. And I say almost because we really thought we were going to have breaking news a few weeks ago. And unfortunately, what happened is not uncommon these days. A very popular bill has gotten stalled in Washington, D.C., and its fate is less certain to us now than we originally thought. But I do want to bring it to your awareness because you may have already heard or you may be hearing from your tax advisor about this dilemma that is embedded in this almost breaking news. So the first topic, and the one that's hitting the mainstream media the most, is sort of one that's least relevant to us in this audience, which is the fact that the bill is going to expand the child tax credit. Now, don't get excited if you have children. You're used to getting the child tax credit. The maximum amount is $2,000. That is not going to change. So the change has to do with people who make very little money and don't have enough tax in the first place to benefit to the tune of the whole $2,000. So for those families, there may be help on the way included in this bill, but for most families, it's not going to have an impact. The thing that's going to impact many of you is the bonus depreciation. So first, what is bonus depreciation? You may recall that depreciation is the way that business owners are able to write off the expenditure for big ticket items. And by big ticket, $2,500 or more is generally the threshold. And the item that is eligible to be depreciated is any item that's going to last for more than 1 year. So we're not talking about, pens and pencils and supplies that we go through like water in the classroom. We're really talking about the chairs that people are sitting on, the cribs that the babies are taking their naps in, the remodel so that you could redesign where the walls are. Those are the big ticket items that usually get depreciated. In the past decade or so, and I say or so because since 2011, we've had ups and downs and ins and outs around this, but there's been this alternative to depreciation, which is, oh, you can choose to take bonus depreciation. And this started out as an economic stimulus program that would allow business owners to deduct the amount that they spent in the year that they spent it. So rather than depreciating a fixed asset over time, I can claim the deduction in the year that I buy the fixed asset. So in 2022, which for most of you, the last time you signed a tax return was for the tax year 2022. Most of you have not yet signed your tax returns for 2023. So in 2022, bonus depreciation was 100% of what you spent. You were able to write off in the moment. In 2023, bonus depreciation has been reduced to 80%. In 2024, it's going to be further reduced to 60%, and eventually it's going to go away. And we're going to go back to a time before bonus depreciation existed. Well, the new bill puts in place bonus depreciation at 100% for both 2023 and 2024. And what's incredibly frustrating about this bill is it is very popular. Over 200 people in the House voted for it. Less than 100 people in the House voted against it. It has bipartisan support. It is hugely popular. And again, it's an economic stimulus tool. It encourages people to spend money knowing that they can get the tax benefit for it right away. Unfortunately, the political wheels that turn as they do, the House almost, not unanimously, but overwhelmingly passed it. Senate is stalled. So we're hoping they'll vote on it this week, this session. However, the shutdown is looming, and so that tends to take the priority. So everybody just has to sit back and wait. The issue, though, is that this is going to be retroactive going back to January 1st of 2023. So what does that mean? If during the year 2023 you placed into service some depreciable items and you want to be able to deduct all of those dollars on your 2023 return, you might want to sit back, allow your professional to file an extension so we can see how this is going to play out. If you file your return using the existing law of 80% and then Congress changes it back to 100%, the only way for you to benefit from that would be to file an amendment, and that costs additional money, additional fees when it comes to your tax professional. So we want to keep our eye on bonus depreciation. For some of you, this will be insignificant. For some of you, it will be tremendously significant. So it's definitely something to keep our eye on. The third and final point of this almost breaking news bill is that one of the ways that they're going to pay for the child tax expansion and the bonus depreciation increase is by curtailing early the ERC program. Now, many of you who are eligible for ERC, most of you have already claimed it. So an early deadline, an early end to the program is of no concern to most of you. However, the bill also expands the statute of limitations in the IRS's favor, giving them more time to go back and look and make sure that the ERC credits that were paid out were in fact legitimate. And it gives them more money to pursue audits of these claims. So I don't want today's topic to be about the ERC credit, but I couldn't talk about almost breaking news without talking about that component that is in the bill. Now, one other thing that Congress has done, and this is not dependent on breaking news, it's already in existence, is if you feel like you were the victim of a ERC marketing firm that swept you up believing that you were eligible when in fact you don't think you were eligible, between now and March 22nd, you can actually voluntarily withdraw your claim, and you'll only have to pay it back at a rate of 80%. So if any of you are feeling squirrely about that big money that you got, it might be worth a conversation with the person who prepared your ERC or another tax professional so that you can get comfortable with not feeling like you need to give that money back. Many of you were in fact legitimately eligible, but I suspect there are a few of you who may have claimed the credit even though you were not eligible. So that's the end of my almost breaking news. Again, this could happen at any moment. Hopefully it'll happen before the March 15th deadline. But my suspicion is that it might happen at the end of March, or we'll find out at the end of March that it just isn't going to happen after all. So the non-breaking news topics that I wanted to talk to you about, so the meat of our discussion today, I wanted to mention first and foremost, I'm curious as to whether or not you are all taking advantage of the PTE tax payment option. And the first thing that we have to do is define PTE, right? So the PTE stands for pass-through entity. And if you look, Kathy, I think I have a little pictogram on the next slide. The first slide represents your business, and the next slide represents you, the people. And normally you think of yourselves as owners of the business, you would go on top, but not in tax land. The pictorial is designed to represent the fact that if you have an S Corp or a multi-member LLC, even though your business in itself establishes profit or loss, that profit and loss then flows through to you on what is known as the K-1 form. And from there, you add the information on the K-1 form to your personal tax return called the 1040. And that is where tax is determined. So really tax is paid at the personal level. So an S Corp owner or a multi-member LLC owner is the owner of a pass-through entity. So when I talk about PTE, I'm talking about those of you who are owners of pass-through entities. Once tax is determined, you pay it to the IRS and possibly to your state, okay? Now, the next thing that we have to discover is what states have an option for a PTE tax credit. And I just want to take a minute and say the reason I put this content in today's presentation is because I'm surprised each year when I see business clients coming to me, sharing with me their prior year's tax return, and lo and behold, they are not taking advantage of the pass-through entity level tax. So that's why I wanted to bring it up so that you can pay attention and know if this pertains to you. So the American Institute of Certified Public Accountants was kind enough to put together this map for us. And the map shows the blue states are the ones that, I don't mean politically blue, I mean the ones shaded in blue. The blue states are the ones that currently offer a pass-through entity option, and there are currently 36 of them. So before we can understand the pass-through entity tax credit, we have to kind of dust off our memory and go back to 2017, which was when the passage of the Tax Cuts and Jobs Act happened. And the Tax Cuts and Jobs Act was passed in Congress in 2017. It became a reality on your 2018 tax returns. And so many of you may recall, let's go to the next image, that this Tax Cuts and Jobs Act significantly increased our standard deduction amount, meaning that you didn't have to work so hard to get big deductions on your tax return, i.e. you didn't necessarily have to itemize. They put the standard deduction very statistically close to where most people were coming in with their itemized deductions. So they almost doubled the standard deduction. But that's an expensive move. And in order to pay for that move, Congress had to limit some other things. And one of the things that they limited was the itemized deductibility, the itemized deduction for state and local tax. So state, S, and you get the idea, state and local tax, often referred to as the SALT deduction. Now, what's interesting about the SALT deduction is that it includes almost all of the taxes that you pay to your state. So whether you're paying taxes for income, or you're paying taxes for your real estate, or you're paying taxes, in some cases you pay personal property, like tax on your vehicle. All these taxes were combined. They used to be unlimited in their deductibility. They were combined to fall under an umbrella that is now limited to $10,000 a year. So for many of you, that may not be a thing, and it may not impact you. On the map of the United States, you'll see, next slide, that the gray states are those states that do not have a state income tax. And in those states, there is simply no need for a pass-through entity tax credit. These states don't have it. If you live in one of these states, this topic should be boring to you because it doesn't really apply. There are 9 states that don't have an income tax. There are a couple of other states, DC, Maine, they're specified on the slide, but it's so small I can't even read it. But DC, Maine, I think New Hampshire, that are currently contemplating legislation, but they haven't yet passed it. But most of the country has a PTE level tax option. And what this means is if you want to be able to still deduct your state income taxes, even though the SALT tax limitation exists, if you have a business, you can pay your state income taxes through the business and therefore deduct the state income taxes on your business, which makes the amount that comes through on your K-1 and goes to your personal return smaller. How much can you deduct? Usually it's the state income tax rate times your profit. So if you're profiting $100,000 and you live in a 5% income tax state, you get a deduction of 5%, $5,000. What does that mean? That you will pay federal income tax on 5,000 fewer dollars. So it's kind of a workaround for the SALT tax limitation. And because it's so prevalent and because it's been around since 2021, and in some states not until 2022, it should become the norm. You should be contemplating paying your state taxes through the business. The issue, if you're thinking, what's the catch? Why wouldn't I be doing this? Is that every state has its own set of rules in terms of when and how these taxes must be paid. And so your advisor needs to become familiar with the rules in the state in which you pay taxes. So the other downside is this becomes just like your personal income tax responsibility, in that you're supposed to pay it in quarterly throughout the year or pay penalty for not paying it in throughout the year. So the next slide reminds us of these dates. They happen to coincide with your personal income tax deadlines. But you may be thinking, I always pay my state income taxes by these deadlines. But if you're not going to the company account or the website to pay through the company, you may not be benefiting from this. And like I said, at this point, it's a no-brainer. So if you're not sure, I recommend that you check with your tax advisor and find out if you're taking advantage of the PTE option. And I think next on our agenda is a poll question. So I'm going to read this to you, and your poll should open up and we'll start to see your answers come in. So how confident are you that you have been paying your state taxes through your business or businesses? A, I'm confident I've been doing this. B, I'm pretty sure I've been doing this. C, I'm confident that I've not been doing this and I really want to start. Or D, I'm confident that I've not been doing this because I live in a state without an income tax. So it looks like we have a tie going. I love watching the responses. So Yeah, so there are at least a few of you that are thinking, if I haven't been doing this, I want to start. So it's definitely a topic for conversation with your tax preparer, advisor, professional, to bring up. And again, if you haven't been doing it, it may be that the only way you're going to be doing it is if you ask them to help you. Okay, we'll give a little more time. I know there's a population of you out there that haven't answered the poll. Just remember, this is just fun facts for us. We'd love if you would just take a minute and pick a response that applies to you. And I see only 3 of you in states where there isn't an income tax, so that's interesting. All right. So an actual majority of you who answered the question are confident that you're not doing this and would like to start. So that means that this information is meaningful, which is great. All right. The next topic is basis and why it's important. And boy, when we're in a Hinge webinar, there are very few topics that matter as much as basis, right? Basis matters on a year-to-year basis, and basis matters overall for the entire life of your business. So the basis in its simplest terms is what you paid for something. But nothing in tax land is simple, especially not when you're the owner of a business. So what you paid for something is sort of an oversimplification. But generally speaking, the idea is if you were to buy a share of Microsoft stock, you would pay something for the stock, and you might pay something for the transaction, for the privilege of achieving the share of the stock. And those two amounts combined total your cost basis in the stock. And then when you go to sell that share of stock, you get money for it. And the difference between your cost basis and what you get in terms of sales proceeds is what we refer to as either gain or loss. Okay. And the idea is the same when it comes to your business. The next slide shows a diagram, and it's meant to be read side to side from left to right. So if you think about when you started your business, you had to put money in the bank account, you had to put money in maybe a down payment for a security deposit, or maybe you purchased a facility. It doesn't matter. Somehow, some way, you would have had to have put money in to initiate your business, okay? And then that increases your basis. That gives you basis. So the arrow on the right side is going up. Then over time, your business, represented by the little storefront, is either going to experience a profit, which is going to give you more basis, or a loss, which is going to reduce your basis. Okay. And then if you take a distribution, like so many of you are getting ready to do when you find out how much you owe for taxes, right? You take a distribution, those distributions reduce your basis. So another way to think about your basis is, what is your skin in the game? And the reason this is such a relevant topic now is because for many, 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 many years, decades, in fact, nobody at the IRS cared about tracking your basis. But as the IRS gets more sophisticated in their ability to track things from year to year through the use of computers, they now require for S Corp owners, and soon they will require for multi-member LLC owners, that we report basis each and every year. And the reporting has a beginning, increases, decreases, and ending balance. And the beginning balance has to match the ending balance of the previous year. So it works kind of like your bank account, right? The IRS wants to be able to reconcile and agree with the amount that you're saying you have in basis. During the life of your business, basis matters because if you have a loss for which you do not have basis, you cannot deduct the loss against other income. If you think in the long term, basis matters because when you sell your business, that's how capital gains can be determined based on how much you had put into it. Therefore, how much did you stand to gain when you sold your business, right? So in the simplest terms, basis is what you paid for something, but when you own a business over time, there are literally dozens of things that can impact your basis. One example of which is non-deductible expenses. The business may have paid for a life insurance policy for you, but you could not deduct that on your tax return. So it does not impact your taxable profit or loss. It does impact your basis. So it's not quite so simple as, oh, my taxable income or loss equals the adjustment to my basis for that year. It's more complicated. Why am I bringing this to your attention? It's important to know that if you have an S-Corp tax return, Form 7203 is the form that has your basis. And if you are not in agreement with the basis amount, you should try to come to an understanding of how you got there with your tax professional, because there is no better time to make a correction than right now. Like the sooner you correct it, the better, and then basis can be accurately tracked in the years to come. This brings me to another topic, which, believe it or not, is directly related to basis. You may be thinking, how could I possibly not have basis if my business experienced a loss? And there are lots of ways, but the most common for those of you in this audience is going to be that you have multiple entities, like an LLC that owns the building and a center that rents from the LLC that owns the building. And they're two separate entities. Usually the center is the S-Corp, and then there's a separate entity that owns the real estate, okay? If you're transferring money from one entity to another entity, you are not doing yourself any favors, because your entity does not have ownership in the other entity and does not need to have basis. So on the next slide, you'll see what you should be doing instead. And as I like to say it, you should become the center of your own universe. You always want to make sure that you are at the center of any money movement between entities. So if my building needs money, then instead of going to my childcare business to get money, my building should go to me to get money. And if I need money, I will go to the childcare business to get the money. I'll bring it to my personal bank account, and then I will transfer it to the building account. And the reason we do this is to make sure that there's a paper trail so that you are getting credit for any money you're putting in or taking out of any of your businesses. These impact your basis. So many of you, if you looked at your balance sheet, you would see that you have a due to affiliate or a due from affiliate. And I'm trying to get business owners to move away from that methodology and to instead create one more transaction so that you become at the center of all financial transfers. This is very, very important and will impact you if at no other time than when you sell the business. And I'll say bigly, like it can have a huge impact. So be sure you're adopting good habits here. Another thing about people who have both a business and a childcare, just as an aside, you want to make sure that you put yourself on a triple net lease, and that the daycare, the childcare center, is responsible for paying the property taxes, the common area maintenance, and the leasehold improvements. Do not let the LLC that houses the building be responsible for those items. Those things, those ticket items, big ticket items, should be paid by the operations of the childcare business, not by the building LLC. Sorry, Kathy, I'm ready for the next one. So here we go. The final topic is, and this is a really good one for the time of year that it is, I want to talk about the current IRS climate and reasonable compensation. So for those of you who have heard me speak before, you know that the IRS is about to start an audit program. When is it going to start? I wish they would tell me. What year is it going to start with? I wish they would tell me. But what I do know is that when the IRS runs an audit program, they're looking at the most recent 3 years. Why are they doing that? Because 3 years are the years that are open under the statute of limitations. And in order to go back further than 3 years, they need to be able to prove substantial negligence. That's uncommon. They don't have the resources to prove that. So they are usually auditing for 3 years. And when I say 3 years, it's really 4 on the calendar because it's 3 years of tax returns that have been filed. And we file, 3.5 months to 9.5 months after the year is over. So they have a look back period of the 3 most recently filed tax returns. So the program is going to be, if you own an S corporation, this is on the next slide, and you're not paying yourself officer compensation, or you're paying officer compensation which is too low to be considered reasonable. We always love the terms like reasonable because the IRS is the only entity that gets to decide what is reasonable, and reasonable is sort of subjective. But if we try to objectify reasonable compensation, you can think, if I were to extract myself from my business, what would I then have to post a job ad for on Indeed, and how much would I have to pay my replacement? And so if you can come up with some idea of what that would be, that allows you to justify that that's amount of wages that you pay yourself, then that would be your defense if you were ever audited. This is reasonable based on X, Y, and Z factors that I found in the marketplace. But just like your directors want to get a raise every year, the IRS wants you to be giving yourself a raise every year because they want you to behave as the owner of the business the same way you would behave on behalf of an outsider working for you. Now, the reason the IRS cares about reasonable compensation is because wages are subject to payroll taxes and distributions of profit are not. So this is only an S Corp audit program. If you have a multi-member LLC, all of your profits are subject to payroll taxes, so it's not an issue. On the next slide, you'll see a picture of Form 1120S, page 1, and I've circled in red lines 7 and 8, and it's really small, but line 7 says compensation of officers. It's really simple for the IRS to figure out if you're paying yourself a reasonable wage because it's the only item that belongs on line 7. What I see day in and day out in my business is that I'll be looking at a previously prepared 1120S for a business owner such as yourself who pays yourself on a W-2, and the tax preparer has not bothered to break that out on line 7, and your salaries are lumped in with everybody else's on line 8. So if you receive a W-2, if you are part of your payroll for your company, and you get a draft of your tax return and line 7 is blank, do not sign that return. Go back to your preparer and say, you didn't break out my compensation of officers. I know for a fact the IRS is going to be using this to determine who's going to be audited. Please fix it before I sign the return. Okay, so this is a really practical thing that you can do. If anyone literally doesn't pay themselves reasonable compensation and can't defend themselves in an audit, then the IRS has the right to retroactively revert your entity to what it originally was. So there is no such thing as an entity that starts as an S Corp. S Corps are formed from either C corporations or LLCs. They can then decide that all of your profits over the last 3 years are subject to payroll taxes, and they will attach penalties and interest. This is very expensive. Please do not find yourselves in that situation. Make sure that you're paying yourselves a reasonable wage, and make sure that it is showing on line 7 on your 1120S tax return. So I think at this moment, I'm ready to open up the floor for some questions. Excuse me. So do we have any, Kathy, from the audience?
We do. We have some fantastic questions. I have a couple of, just to mention again, and I'll jump over to the questions, which are great. In bonus depreciation, is there a limit on the amount? No limit.
No, nope,
Okay.
it's a beautiful gift if we can get it.
For anything that's depreciable?
No, there are. So if you have a building and you make changes to the inside of the building as a tenant, and those are leasehold improvements, those are eligible. But if you own a building and as the owner, you have to replace the roof, that is not eligible, which is why I say triple net lease, because the lessee is eligible to classify these as leasehold improvements, making them eligible for bonus depreciation. Great question.
Right. Okay. And could you repeat the form that a business owner could reference to find their basis? What was it?
7206, and it's only with an S Corp return right now.
Okay.
I think there's, I would have to check my software. I think that there's a 7206 type of form available for multi-member LLCs, but you would have to ask for it because it doesn't get filed with the return.
Okay, awesome. The only other comment I have is I got a little bit of a chuckle over how much would it cost me to replace myself, because I imagine these business owners wonder how many people that would take to actually replace themselves.
It's so true. And I will say this, the IRS understands that the owner of the business benefits through profits, but that the work that you do on the day-to-day needs to be quantified in terms of what it would cost to do the data to replace you for the day-to-day. So you don't have to replace yourself for being the visionary or being, necessarily the CEO role. It's more like the day-to-day work that you're doing.
Okay, let's, I'll jump down to questions that we had around that, just so that when we can go back up to the top for some other questions. But a couple of questions related to that. The first one is for reasonable compensation. Can you talk about the difference between an active officer who is running the business, such as an executive director or financial partner, et cetera, versus passive officers who might get a W-2 but don't have actual duties?
Great question. If they don't have actual duties, they shouldn't be getting a W-2. So issuing a W-2 to a passive officer is kind of a no-no. But every business has to have some officer who is active. So line 7 should never be blank. But to your point, it is possible to defend an officer not getting a wage based on the fact that they don't participate in the business. The challenge is that there is a difference between a passive officer and an active officer for tax treatment. So you want to get the benefit of being active in the business, and yet you want to get the benefit of not paying the reasonable wage. So there is something called significant participation. It gets more complicated, but this is a conversation worth having with your advisor.
Great, thank you. Also, would all officers' compensation be lumped together if they're multiple owners?
Yes.
All would be on line 7.
Right? Yes, and as a matter of fact, Kathy, you reminded me, if your S Corp is paying health insurance for you, the officer, then that amount goes on your W-2 and it goes on that officer compensation. So that can help you look good in the eyes of the IRS because it beefs up your numbers.
Just health insurance or any other benefits? Just health insurance.
Mm-hmm.
Okay. If you put yourself at the center of all financial transactions, do you have to pay taxes on that money that is being transferred as if it is income? So I think we're going back to the you.
I love this question. So you can move money around however you want, and it doesn't create a tax. Tax is created at the moment the money was received at the level of the entity that is reporting the profit. Moving money from bank account to bank account is not a taxable event. So I always say to people, take your money. I hear people say, I started a business, but I haven't touched any of the money. Well, you're still going to pay tax. So you might have to take some of your money out to pay the tax.
Right. Okay. I think related to the same slide came this question. Does this create a loan from one business to you as borrower and then a loan from you to other business as a borrower?
Say that first part one more time.
Does this, so I think this relates to the our visual with you in the middle.
Yep.
Does this create a loan from one business to you as a borrower and then a loan from you to other businesses as a borrower? So is there a borrower relationship?
Yes, just as it created a loan from your one business to the other business, you're now substituting yourself in there. And if the loan is going to last more than a year, you need to impute interest. It's a modest rate, but the rates are going up. The rate these days, I think that the IRS wants to see is 8%. But the alternative is that your one business is loaning the money to the other business. So there's a loan either way. The benefit of you being the lender is that you get debt basis. It's called debt basis. So it helps you in the overall picture of being able to deduct your losses.
Great, thank you. Do you know why ERC payments have been stalled? Our guest here applied months ago and has not heard back.
Yes, never fear. Okay, I literally had a meeting with the Criminal Investigations Unit of Chicago IRS office on Monday, and I asked this very question: when is the IRS going to resume processing? I have claims that were submitted in July of 2023 that have just been sitting there. They said they would resume processing January 1. That is not true. That has not happened. They have not, in fact, resumed processing. So I got it straight from the IRS's mouth. They have not resumed processing. When are they going to resume? I don't know. They don't know. We don't know. But the good news is the assurance I was given was if your ERC claim is legitimate and it was submitted on time, it will eventually be processed.
Okay, wonderful. Be patient.
It's so hard.
Yeah. Where will you find on your tax return if the PTE is deducted?
Great question. It varies depending on your state. You kind of have to hunt for it on the state return. On the state return, in the section where you're making tax payments, there will be a line that says PTE, pass-through entity tax credit. So what happens is the entity pays the tax, and on your K-1, they pass through the credit for having paid that tax, and then the credit gets claimed on your personal state income tax. There isn't a one-size-fits-all. If this were a federal issue, I could point you right to the form and the line number, but because it's a state issue, it varies by state, but it is in the payments section. By the way, if you're in a state that has the PTE option, there will be a line that says pass-through entity tax credit, and it'll either have a number on it or it will be blank, depending on what you're doing.
Awesome, thank you. I love this next question because I need to know this myself. When paying taxes as an owner, do we pay directly from the business or should we transfer the funds to our personal account to pay the IRS?
It's a great question. So if you're paying the state tax, like I'm suggesting you do, that tax would be paid directly by the business. But all other taxes should technically come from your personal account. Realistically, we know that you need to fund those payments with money from the business. So transferring it to your personal account is great. Your financial team, Christine and Zach and Stephanie, are phenomenal at tracking this separately from regular old distributions. They track tax payment distributions so that when I'm working with one of their clients, I can hone in and see exactly how much was paid to whom and when. It's in the equity section because it is a distribution, but it allows me the paper trail. So that is also an acceptable method. It's just that the danger of accidentally deducting it on the business return when it is in fact a personal tax is scary because that's not allowed.
Thank you. Are we penalized for transferring owner withdrawals at any time, or should these transfers be scheduled?
There's no penalty. Some people would say, because these are similar in nature to dividends, it's good to pay them on a monthly or quarterly cadence, but there is no penalty ever or reason not to pay as you go, as long as you're having distributions that are at least quarterly. So more frequent is not bad, but less frequent, you probably want to move to a quarterly cadence.
Good to know. Thank you. We have one more question. If you guys have more, certainly add those in the Q&A box. This is fantastic conversation and love your input. Well, there we go. There's more. Do you recommend having written job descriptions for owners who are on payroll to justify their role in compensation for audit purposes?
I'm so sorry. You got me so excited. I glanced at the Q&A. Can you say that one more time?
I sure can. So for owners who are on payroll and for audit purposes, should they have written job descriptions to justify their role in compensation?
There is a whole cottage industry that talks about, among accountants, accounting professionals, reasonable compensation. The more you can demonstrate and document and use to justify, the better. So I would say yes, with an exclamation point. Great idea. Yes.
Yeah, love that. If your tax professional hasn't been claiming PTE for the past year, should we amend state taxes, and should we go as far back as permitted?
There is no such thing. It is a use it or lose it option in real time only.
Okay. We hate that answer, but.
Right.
Okay.
I agree.
We hear you. But we hear you. Okay. If we receive the EPR funds, is it something that we need to adjust for the years of 2020, 21, and 22? If so, do you know what percentage will be charged for those funds received?
I think they meant ERC. It read as EPR, but I'm going to assume they meant ERC because it fits ERC perfectly. So yes, if ERC credits were available for the year 2020 or 2021, if you filed for ERC credits in both of those years will need to be amended. The tax that will be assessed is exactly the same as it was on the original return. It's going to flow through to your personal return. So therefore, the business and the personal returns need to be amended, and you're going to pay tax by lowering the amount of wage expense that was claimed dollar for dollar for the amount of ERC credit for that year. If you receive the money in 2022, then in 2022, you should have reported the interest income that came along with those ERC credits. If you receive the money in 2023, the interest gets reported on 2023. So the interest gets paid when received, gets taxed when received, and the ERC credits get taxed for the year for which they apply. Great question. And I see a lot of people doing these incorrectly. They're putting the whole ERC as other income on the year that they receive it. It is completely inappropriate and will get audited, and it will be a mess. So better to get out in front and correct it now.
And yes, we did confirm ERC was
okay,
what
good.
we were doing for there, but you knew what we meant. Tax world has a lot of acronyms in it.
That's so true.
They're really hard to keep up with. Those are our questions, and those were fantastic. I learned a lot, Laura, and I really appreciate you taking the time in your busy, busy world. Are you going to produce tax returns for the next 10 hours? And is that what the rest of your day looks like?
It sure is. And you said it right, because my day usually ends around 11 p.m. So you got it right.
I used to live in your world. I know it. It's why I'm not there any longer. But okay. Well, we sure do appreciate you and not only your wealth of knowledge, but your ability to both break it down in a conversation that's easy to follow and to gear it toward our industry. So I think that those two things are super helpful. And the team at Hinge appreciates you. And thank you to our guests for joining today. If you guys have any other questions, where can they find you, Laura?
Oh, good question. I should put it in the chat, don't you think? If I just
Yeah,
put
do
my
that.
email in the chat.
Put your contact information up there. I'm sure that our friends will wake up in the middle of the night, and don't send her a message then, but she'll probably be awake. But
I don't mind emails in the middle of the night. I really don't like text messages in the middle of the night.
oh yeah, okay. Don't put your phone number up there then. But yeah, you guys should see Laura's email.
Is it there?
Chat. There we are. Thank you so much. Thank you everyone for joining. And Laura, we will see you soon.
All right. Thank you so much for having me. Have a great rest of your day.
You too. Thanks.